And good afternoon, financial professionals. My name is John Florence, and I am the Senior Vice President of Marketing here at E4 Insurance Services, welcoming you once again to The Brew, where we build relationships every week. Thanks for tuning in today. For those of you joining The Brew for the first time, we like to start the Brewcast by celebrating today's national days. I've picked 3 of them today. Today is National Macaroon Day. If you're not familiar with that lovely little dessert kind of pastry cookie with a little cream filling, been around for a long time, originated in Italy. And I don't know how to even pronounce it, but the word macaroon comes from the Italian word for paste. So if you haven't had one of those recently, I encourage you to go out and try them. Pistachio is my favorite. Today is also National Flip-Flop Day, which is seemingly appropriate as we approach the beginning of summer and warmer weather. Get a pair of those, as my father calls them, go forward shoes, and enjoy those for the next few months ahead. And then lastly, today is National Speak in Complete Sentences Day, which I'll endeavor to do for the rest of this presentation today. On today's Brewcast, we welcome Mass Mutual's Managing Director of Life, Geoff Murtha. Geoff, welcome back to the show. Happy to have you here. Geoff will be sharing with our attendees how using whole life insurance can be a diversification tool in your client's overall portfolio and can increase the likelihood of a successful retirement while at the same time enhancing the value of your overall practice. Before we get started, I'd like to remind you of a couple of quick housekeeping items. Please feel free to use the chat box to share your thoughts or ask questions. Also, all attendees are in a drawing for a CE voucher and a Starbucks gift card, and we'll be announcing the winner at the end of the Brewcast. Thanks for tuning in. So, Geoff, nice to see you again, and happy to have you back. I think we were chatting just before we got started with the recording that we do about 49 of these Brewcasts every year, a couple of weeks that we take off during holidays. But and we like to track the statistics on them. And you had one of the highest viewed Brewcasts from the last time that you were here, sharing with us about some of the myths and dispelling those myths about whole life insurance. So welcome back to the program today, and thanks for being here.
Well, thank you, John. I'm really hoping to set the bar even higher this time. So thanks for letting me know. And thanks everyone for being on the call today. I know your time is very, very important. And I really appreciate E4 giving me the stage to talk a little bit more about whole life insurance. And today, it's a really fun topic for me. And it's been one that's been really, really well received by a lot of agents out there who, a lot of them haven't sold a bunch of life insurance in the last 20 years because their practices kind of moved on. And for good reasons. A lot of AUM-oriented folks have enjoyed being able to rely on some reoccurring revenue that they're going to get every single quarter. Now, it goes up, it goes down, because a lot of that is going to be predicated on the market assets that they're managing. But it's really a part of most everyone's practice in the financial advising world. Now, if you're not in that space of AUM, that's good too, because a lot of you folks that are life insurance, disability insurance oriented still partner with financial advisors. And this story is really going to help resonate with your referral partners. And it's just a good story to be telling your customers. So I'm going to go ahead and really get going on this, share my screen. Hopefully I don't break anything. And John, you can give me a nod and let me know that it's sharing. We're good to go. All right.
I'm giving you a thumbs up, but that doesn't look like you.
It does. You know what? I do this whole trick. I learned it from a lot of the old timers in the insurance industry, where I put a picture that is 10 or 15 years old on the screen just to make me feel young when I'm talking and people can't see me on camera.
Fair enough.
So today, and as John mentioned, we're going to build resiliency, not just for your clients, but for your overall practice. And the first thing I actually want to bring up is an E&Y study that was done, I want to say beginning of last year, and it's called Benefits of Integrating Insurance Products into Retirement. And this was a really cool study because they took five different investment strategies, and they looked at what's going to create the highest probability of a successful retirement. And what they eventually came to, and I'm just going to kind of flip through so you get to see, there's a lot of numbers, statistics, graphs, charts. So for folks who really resonate and can understand and digest that information, it's here, scatter plots. So it's really, really official. But what I like about it the most is that it's a third party. I mean, Ernst & Young is a big accounting firm. It's third party. They're not insurance related, but it does tell a really good whole life insurance story, because the conclusion is what we're going to talk about here is how do you create a buffer asset that's going to help increase the probability of a successful retirement for your clients, because everyone is planning to potentially work, or almost everyone's pretending to potentially not work at some point in time and live off assets that they've grown. And we talk about retirement in the financial world as building assets and managing risks and looking at numbers. But the most important piece of retirement for most of the people who are going to retire are the things they get to do in retirement, right? It's going on vacations. It's being an empty nester. John, we're talking about that. It's having the freedom to go from one part of the country to the next in an RV, or buy a lake house, or buy a beach house, all these different things. That's the important part of retirement. But you got to get the money right first. You got to get the money right first so they can enjoy that kind of retirement lifestyle that they're actually looking forward to. And there's a lot of risk, there's a lot of hazards, there's a lot of peril that we as advisors can help our clients overcome and create that successful retirement, not just from a money perspective, but for all the really cool things that they're going to want to do. So the presentation is going to focus on building that buffer asset and creating a successful retirement. So the portfolio maintenance tool side of this is what's in it for the customer. We're going to build this asset that's going to shore up some of the holes in a retirement income portfolio. More to come on that. Really, it's going to protect from sequence of return risk. That's something that everyone on the call probably has heard, knows. We'll do a very small review of that. But ultimately, it's going to enhance the overall long-term growth of the retirement income portfolio. So what does that mean for you, the agent? Well, we're going to protect the AUM that you currently have, and we're going to build on it. And that's going to be a really key piece of your financial future, because we're protecting your future paychecks, and we're going to actually protect current ones as well, while diversifying your reoccurring revenue stream. This is important because if you haven't sold whole life insurance in a number of years, you might forgot that renewals are really, really strong. So if you've been going away or shying away from life insurance or no longer sell it in the capacity that you might have used to, now's a good time to get back, because with Mass Mutual in the brokerage space, you are going to be able to have this recurring revenue that is not tied to your AUM, where if you take a 10 or 20% pay cut this year because of the market, and I know the last couple of years, some of the quarters haven't been that great. We've been taking pay cuts on AUM. It would be nice to have a hedge against that. And because the renewals on whole life insurance are not tied to AUM, it's a great hedge. And so you're diversifying your recurring revenue, and it aligns with your practice even more now. And then we're going to develop business with the next generation of clients, because if you haven't been telling this sequence of returns type of story and putting into a strategy of using life insurance, you don't have as many potential death claims in the future that you are going to ultimately have the opportunity to help invest. I know it's kind of morbid to look at that as a revenue stream, but it is. And if you're not out there developing or trying to strengthen relationships with the other spouse, who you may not think is in control of this life insurance sale right now, but ultimately might be in a little bit more control than you think, and will definitely have control of what happens with that death claim, or with the children or any of the beneficiaries. You want to build that strong relationship. And I think we've been to enough seminars here lately where they tell you, do not discount anyone in the sales process, build relationships. And so this is going to do a good job of, when you're telling this story, creating opportunities for the future. So how are we going to actually get all this information? Mass Mutual Strategic Distributors, we have a tool that we call Simplify. There's 12 different modules. The one we're going to talk about exclusively today is called Taming a Bear Market. I'll shoot this out over to John and everyone at E4, and they can show you what types of other modules we have, but it's a pretty cool system. We take conceptual material, client information, and the illustration put together in an easy to digest format that you can go demonstrate to the client and help them understand and absorb what it is that you're actually trying to get them to understand. So as I mentioned, tame a bear market in retirement, that is the one what we're going to discuss today. And this is the title slide, short overview of sequence of returns. It doesn't really affect you in the accumulation phase. It only affects you when you're taking out money. So you start with $1 million, you have one order of returns, you get the same amount of money in the same return if you just reverse those, flip them upside down, because we're not taking out money. So the hazard is really when we're taking out money. Well, guess what you have to do in retirement? You're going to have to harvest these assets in the future. And it would be a shame if you have some negative years, especially at the get-go. So scenario one, it shows if we have $1 million pool of assets, we take out $65,000 per year, we're going to have a successful retirement because we had a couple of good years to start. Even those bad years at the end, they don't really hurt us that much because we still have $900,000 that we can leave as a legacy, that we could spend more, have grandkids, kids, college. And we see a lot of that right now where retirement assets are being used to fund life insurance, $20,000, $30,000, $40,000 of premium per grandkid or great grandkid. So there's a lot of things that you can do if you have the ability. Scenario two, not so successful retirement because we start with a couple negative years and we fail. We can't even spend all the money that we wanted to spend. So how can you as the advisor be able to put them in a position of power so they can still do everything they want in retirement and not have to take the money when they shouldn't? Okay, so this is how we come up with the buffer asset. When there's a -7 or a -12, a -2, -5, whatever the negative number, take from the life insurance, allow for that money to build back up, and then start taking and liquidating from the retirement asset again. So why is whole life insurance a good buffer asset? It's because it's diversification. It's not correlated to the market. You're going to be able to get very strong returns with assuming a lot less risk than you are in your retirement income program. How are we able to do this? Guaranteed cash value is going to grow every single stinking year. Every year, the guaranteed cash value is going up. On top of that is a dividend that's historically a lot more reliable than other alternative assets, and it's less volatile. We have a new piece out that really tells this story. It matches up a bond index versus a stock index versus a 50-50 blended index, an IUL index, and the MassMutual's dividend interest rate. Not only do you see that historically we have strong interest rate return in comparison to those other assets, but the standard deviation is so much smaller, which means we have a higher risk-adjusted rate of return. There's a lot more certainty in what whole life insurance can do, which is perfect for this buffer asset story, something you can rely on. Also, I threw this in here because the first objection we get is, well, you can't sell whole life insurance in a decreasing interest rate environment. Well, we had a policy that went in force in 1980 in this example, and the gray part of this graph is guaranteed cash value. That doesn't change. The light blue is what was projected back in 1980 as a dividend return. The dark blue is what we actually paid. So even with interest rates going down since the 1980s, we've paid more in our dividend than what was projected. And that's this piece is one of the strongest pieces that we have out there telling the whole life insurance story and dispelling some of those myths like John said what we talked about last time. All right, so here's the actual output. This is going to show you what you're actually saving on the client's projected hypothetical retirement portfolio, which here we're saying it's $5 million, going to retire at 65, targeting $250,000 of income for 20 years. So after 20 years, we're going to save or build up $2.8 million more of retirement assets than what would have had without the insurance. Okay, so investment only, the assets would be about 4.6 million. With the buffer, it's going to be about 7.5. So this is how you protect and build AUM in the future, not by taking from a depressed asset. So in this example, SP 500 returns a 24% return. It's not only that your account value goes from 5 million down 24%, it's that you take out that $250,000 from the retirement account, and that $250,000 doesn't get the next year's 26%. It doesn't get the next year's 9%, 3%, 13%, so on and so forth. That's the opportunity cost, is what you're actually not able to return on that $250,000. So how are we able to calculate that and make it easy for the client, make it easy for you, the agent? If you look at the far right-hand column, that's the amount that we're actually protecting by using this buffer asset strategy. By taking from the life insurance in those depressed markets and allowing for those monies to come back up, we can show you that in the first year, it's 191,000 that year. The next year it's 242,000. The following year it's 263, 271, all the way until you get 20 years down the road, and it's $2.9 billion. That's real money to the client that funds their lifestyle, that funds their gifts that they could potentially, it funds kids' college. It does things and it opens up their world from a protection standpoint. For you, the advisor, that's real recurring revenue. That's increasing the value of your business. That's creating resiliency, because not only do you have this for protection, you have the diversified recurring revenue stream and the potential to help invest those death claims. I know that we're running over here a little bit. Here's the life insurance proposal, and where are we seeing the money come from to fund the strategy? It's found money. It's assets managed by a competing advisor, stepped up in income, windfall. CDs right now, a lot of advisors are putting money in CDs, and as that money matures, they're taking portions of that every single year and they're putting into life insurance, left pocket, right pocket, because the cash value is going to be there and the guarantees. And you have a death claim or death benefit that is going to spend a lot bigger than what the CD would, especially when those CDs are earmarked as a legacy asset. And then using it as a bond portion of the portfolio is a very big story we're seeing right now. So with that, John, I'm going to bring it back over to you. There might have been some questions, and I can certainly take some over email as well.
That is amazing. And yeah, if you don't mind, stop sharing your screen. We'll just chat about this for just a second. So really an awesome idea. And I think, as you say, particularly given what we've seen happening market-wise in the past year or so, since really the beginning of 2022, where the markets really started taking a downturn. I know a lot of both advisors and clients are really concerned about their portfolios as they move forward, particularly through moving into retirement period. So, you're talking about this as an alternative asset class. And what's the best time for somebody? What's the right age for a client to start doing this? It doesn't seem to me, and correct me if I'm wrong, that you would take somebody who is on the verge of retirement right now and try and do a plan like this. Is that enough lead time, or do you need time for that insurance to be in place to really do its thing as part of the portfolio? Talk about that a little bit on the time.
Yeah, that's a very good question. Most of the people who we see trying to do this type of strategy, they're in between 40 and 55. We've seen folks do 60, 65, but they're in more of that CD repositioning type of feel where the money is going to be there. They don't necessarily need it. It's a nice to have, not a need to have, and it's going to be more of a legacy asset. So the death benefit makes sense. But at the same point, they still want to pull from it if it was needed. But to really hone in on what today was discussed about, it's in that 40 to 55. I mean, we see it with the 28-year-old, with the 33-year-old, with the 35-year-old, but I think it's mostly in that 40 to 50, 55 world.
Okay. And then as far as like an asset or a portfolio being overall depressed, is there a particular asset class that's better to look at right now? I mean, we know we're just in one of those weird times where fixed income and equities are kind of moving a little bit in lockstep. And so normally when equities go down, you'd see your fixed income portfolios rebounding, but that's not really happening, right? We've had a horrible year in bond indexes over the last few years. So if you were going to do this, which asset do you go for first? Or is there any thinking along those lines?
You know what? That is such a tough question today, because up is down, left is right. In this world, there's so much uncertainty everywhere with everything. The way that I look at it, if you're assuming risk and you're in that 35 to 45 age range, you're going to assume risk. You're supposed to wait it out anyway if the market goes down. But if you do have a portion that you are putting in towards bonds, the way I'm looking at it is that the long-term return on whole life insurance is probably going to be similar or hopefully even greater than what you could expect over the long term with bonds. And you're going to assume less risk with that. So I feel like if you do want to position it as the bond portion, that you're going to be, in my thought, probably doing yourself a favor long term. Because if you look back in the 1980s when CDs were going for 18%, you would probably say, I'm going to do a 9-month or a year CD for 18% instead of doing like a 20-year bond for 12%. Obviously, the person who did a 20-year bond for 12% ended up doing better, but everyone flocked to 18%. I think the same thing kind of applies now, where using whole life insurance that might only get you 5 or 5.5% over 20, 25 years, that might be better than chasing the 6% CD.
Yeah. So sort of repositioning maybe of a portion of the fixed income portfolio, especially, I haven't looked at it lately, but in the last several weeks anyway, the long-term yield curve being inverted on those things. If you're truly looking at a great place to park a long-term asset, something like this would be a good fit.
Yeah, it's a great time to be at college studying economics, and probably not a great time to try to guess where things are going.
Yeah. Yeah. Well, listen, that was a really great share. Thank you so much for the information. And while we're waiting to see if there are any final questions in the chat box, I'd like to remind everybody that today's brew and our entire library of brewcasts are recorded and shared on the Brew blog on our website at www.e4.insurance, as well as on our YouTube channel at YouTube. Just Google YouTube E4 Insurance Services, and you'll see all of the different episodes. Now for a giveaway, Geoff, please pick a number between 1 and 20.
12.
12, and our lucky winner is Tony Griffin. So Tony, congratulations. Be on the lookout for the complimentary CE voucher and Starbucks gift card that'll be coming your way from all of us at E4 Insurance Services. It doesn't seem that there are any additional questions in the box. So Geoff, thank you again for your participation today and for your continued support of the efforts that we do here. We look forward to more interesting brewcasts like this in the future.
Absolutely. Thank you. I appreciate the time, and everyone have an awesome and amazing summer.
Yeah. And join us next week here at E4 as we welcome Cincinnati Life's Maria Okrant and the principals Mason McKinney. And they're going to be sharing solutions for employees and families by utilizing 2 great programs that pair well together to keep all employees at a company feeling appreciated and financially secure. That's next time here on The Brew. Thank you and have a great afternoon.